2020 was an extraordinary year for equities. After hitting extreme highs and extreme lows, the last month of 2020 saw new highs on Wall Street. The S&P 500 rose to new highs by mid-December, with the Dow staying above the key 30,000 mark as well. Fiscal and monetary support, coupled with vaccine optimism to tackle COVID-19, have propped up investor hopes. Experts say the positive trajectory for equities will likely hold in 2021.
The outlook generally is pretty good for equities relative to fixed income. We do think that the central banks will maintain a loose enough policy to prevent fixed income assets from underperforming, that is, for yields to rise too much. And this should facilitate growth and facilitate equity markets.
Strong business investment and solid government policies will be key drivers for equities.
The new Biden administration looks like it's going to be more clear, or at least predictable, in terms of its policy initiatives. And in China, we've also seen a very clear articulation of policy over the next 5 years. So with this clearer policy outlook, positive growth, we think businesses will start reinvesting, and this will provide a very strong cyclical element to future growth in 21.
Cyclical stocks that rise in demand during economic upticks stand to benefit. The growing focus on green energy could also pave the way for higher infrastructure spending.
Global financials, for example, are well positioned and valuations are quite decent. Secondly, in terms of tactical positioning, we think that regions like Germany, for example, and Latin America are attractive for a couple of reasons. They're more exposed to cyclical parts of the economy. They also tend to be big suppliers in terms of exporters to China, and we think that Chinese growth is in a pretty solid footing.
The ongoing vaccine rollout in various parts of the world could also kickstart consumer spending.
With the relief of a vaccine, it's going to almost be like party time. So conspicuous consumption, whether it's cars, people moving houses, going on holiday, all of these things, I think we'll see a huge amount of spending just through pure relief and also clearly pent-up demand.
Still, the Global CIO Office expects 2021 to be a tale of two halves, with the illusion of strong recovery in the first half and a reality check towards the year end.
The stimulus is going to provide the first half's performance. Year on year, numbers are going to look profoundly good when we get to the March to June period of 2021. But I think beyond that, I think a number of governments will start to say, I really don't want to spend too much more money because my deficit is already high. The burden of debt for future generations could be quite substantial.
Investors are cautioned about going overweight on US and European stocks, as experts say a bias on Asian equities could have a better payoff.
Returns of the US market of somewhere around about 3 to 5% and not the 7 to 10% that perhaps people thought they could achieve. Don't get carried away with the rally we've seen in markets. A lot of people now think that we're back into markets where we're going to see consistently 10% plus returns from equities. Don't bank on it unless you're taking risk by investing in the emerging markets or certain parts of Asia, which we would encourage people to do.
Technology stocks that have outperformed in 2020 could still see strong performance. But with many facing regulatory scrutiny in Europe and the US, smaller thematic tech plays in the artificial intelligence space could be better options.
Only buy things that you really believe in for the next 5 to 10 years. So don't go chasing the quick, hot tip that you hear that's going to recover quickly from this vaccine and from other things. Those will be transitory profits. Equities are a good bet for the first half of 2021 or until they've gone up probably 10% from here. But no, the back end of the year will be more challenging just because of the slowing global growth.
Here in Singapore, equities could see better days after being among the region's worst performers in 2020.
We expect Singapore to outperform the Asian peers and cover up some of these disappointment that we had in 2020. In terms of recovery, we are expecting earnings growth of all about 30% for the STI index. That's our top-down estimate for 2021. For 2022, we are looking at about 13% in terms of EPS growth for the whole STI index. In terms of valuation, where STI is trading right now, it's pretty close to this historical average since Jan 2008. We think that valuation is reasonable. So our 2021 end STI target is 3144. It's about 11% upside from current levels.
Singapore's retail sales and private consumption are set to benefit from further easing of COVID-19 restrictions.
In retail malls, we are only 10% below the pre-COVID levels in terms of visits. So that's a very positive sign. So we are recommending investors to get into these sectors early and start taking positions. These are still cyclical and value, but focused on domestic recovery.
RHB Bank Singapore recommends a barbell strategy, where domestic consumption plays like F&B and land transport are balanced off with high-yielding growth stocks.
A good example would be ST Engineering, or industrial names, Sheng Siong in the consumer space, where you definitely would see earnings recovery or earnings growth to sustain, and it will be defensive in nature. Or you could look at glove manufacturers.
For vaccine-dependent sectors like aviation, real estate, hospitality, entertainment and healthcare, earnings recovery could pick up by year-end.
We still think there's downside risk because we are not out of the woods yet. We feel quite comfortable inside Singapore, but within the region, COVID-19 is still showing re-emergence. All this optimism around recovery can still fall through. So stay protected on your downside, and then if you have liquidity available, keep buying into cyclical names.
For now, investors should also keep tabs on risks coming from the US-China trade war, corporate restructuring among Singaporean firms, and potential consolidation in the real estate investment trust or REITs space.